Well, uncertain times are even better for us than certain times because we always say good returns are made in bad times, which means that the opportunity to find good investments is generally not around when times are rosy. So our approach of following a bottom-up investment process means that we're looking continuously for opportunities which score well on our 3M approach, which means that we're looking for companies of sufficient quality, so a strong moat with management teams which are capable, and then margin of safety. And this is specifically what I reference when we're talking about times which are challenging, is that the margin of safety tend to be wider, and that's when we're finding opportunities. So right now for us, there are actually plenty of opportunities around, especially in the domestic market, and our process tailors quite well to this. So if I look at the PSG Stable Fund at the moment, we just over 34% in equities. Offshore equity is a very good counterbalancing position to our government bond holding of about 15%, because we do look at correlations in portfolios. But also we believe that both those asset classes at the moment are giving us very satisfactory returns. So our offshore equities are, we believe, very attractively priced, and we expect to generate very good returns from these companies as they are out of favor for some specific reason in every company's case, and they remain very high quality companies. In the domestic market, which is about just over 20% of the portfolio, we're finding numerous opportunities, especially from a margin of safety point of view. There's a lot of pessimism in the market at the moment, resulting in high quality companies run by very capable individuals being available at prices which we probably haven't seen for a long time. So from the equity point of view, the portfolio is on about a 12.8 PE ratio, resulting in an earnings yield of 7.8%. We believe this is an indication of the return you'll get from the equities if we take the earnings yield and add inflation and add a bit more for the quality of the company, which means it'll grow its profit ahead of inflation, and re-rating as it actually moves towards a fair value. We'd expect returns in excess of 14% in the medium to long term from these equities. Then if we look at the bond holding in the fund, which is yielding a very attractive yield at the moment of 9.4%, this makes up 41.8% of the fund. This is a combination of credit and government bonds, and these yields which we've locked in now for our clients should help us go a long way in assisting us to reach the inflation plus 3 benchmark, which is probably about at the moment at a run rate level between 8 and 9% requirement. Then we look at the cash holding, which is yielding us 8.7%, which is 24% of the fund. So if we look across all three of those asset classes, we believe we're getting very attractive returns, and we're in a very good position to achieve the fund's benchmark over the medium to long term. The largest changes would be a reduction in the exposure to offshore equities, increase in the exposure to government bonds, and an increase in the exposure to credit. So the aggregate equity exposure has actually been reasonably flat, only declining from 36.4% to 34.2%. But if we look in that, the offshore exposure is actually reduced from 15.6% to 12.7%. And this is the result of numerous of the names held in the portfolio approaching or achieving the fair values. A few of the names which have either reduced significantly or been sold out completely would include Berkshire Hathaway, SoftBank, Markel, Microsoft. On the additional side, we have found new opportunities like L Brands and Babcock and Highland Joinery in the UK, but we found less new opportunities than the number of companies that we've exited, which is what you'd probably expect in a market which is moving towards levels which are probably quite demanding. The domestic equity side, we're still finding numerous opportunities, and the exposure in the funds actually increased slightly to domestic equities from 20.8% to 21.5%. If we look at the government bond position, it's increased from 11.5 to 15.4. This is not really the result of yields increasing on the government bonds. They were more flattish over the year, although there was a spike during the year. It's more a result of us getting more conviction in the strength of the institutions in South Africa. So the central bank, treasury, the functioning of democracy within the country, and also a healthy competition within the ruling party. And this has given us enough conviction to move about 5% of the fund's cash into government bonds, on which we're getting a sufficiently higher real yield in excess of 9.5%. Then if we move to credit, there's been a significant increase in the fund's credit exposure from 14.5% to 26.5%. And this is also what you would expect in a market which is very pessimistic about the prospects of South Africa. We're seeing various measures of confidence in the South African economy being at very, very low levels, which we haven't seen for decades. And as a result, a few of the credit names become available at very attractive prices. We would reference FirstRand Group and Landbank, which were large additions to our credit portfolio, with the Landbank being one of the very few SOEs in which we have any amount of confidence, but the only one which actually passed our credit hurdle. And that's specifically because it's under the administration of the National Treasury. And we've been able to lock in very attractive yields in Landbank paper because they were very desperate for cash, like all other government entities over the course of the year. Then if I look at the movement in cash, which is the balancing factor, as we've increased our exposure to government bonds and credit, the cash has reduced from about 37% to 24%. The liquidity in the fund is more than sufficient. Government bonds are very liquid and cash is very liquid, so the total liquidity is about 40%. But with that cash holding, we are able to move into, for example, property if we should see a correction in property prices. There's been a bit of a correction, but we haven't approached values where we think there's margin of safety. But while we're waiting for those opportunities, the cash is yielding a very attractive yield at the moment of about 8.7%. So if we look across the portfolio, there have been reasonably significant changes, with cash reducing exposure to bonds increasing. But we believe that the liquidity is more than sufficient, and therefore we've got no concerns.